Hey everyone, Greg Towner here with Parallel Portfolios for our 5 charts in 5 minutes for September. So let's get right into it. You know that we like to start off looking at the S&P 500. And today we're going to focus in on this right-hand side of the chart. This is where we've been talking about the wide sideways range that the market's probably going to be in for a while. And lo and behold, it has been in that range for a while. We're maybe above the halfway point at this point. The last month or so has seen a little bit of market weakness. That's not to be too surprising here. We are in the normal seasonal weakness period. There's a few more weeks of that left. Hard to say, of course. Seasonals are just one small factor in the whole scheme of things. But as we start to think about how we might eventually break out to the upside, whenever that is, hard to say. There's a number of things that you can talk about, but one that we're going to focus on today is earnings. Over the short term, there's a lot of different things that affect the stock market, a lot of it behavior based. But as you look out longer term, ultimately, corporations need to have growing earnings for the stock market to move higher. So this chart here, this darker line is the S&P 500. And the lighter line is the earnings estimates that analysts out there have for those S&P stocks. And we can see, after they kind of had a doom and gloom view of things coming into the start of this year, they've quickly realized that, hey, earnings estimates are actually a little bit stronger than we thought they were going to be. And they continue to ratchet those higher. In fact, now they've actually moved higher than the S&P, comparatively. So, it's hard to know with everything going on in the world if corporations will still be able to grow their earnings and even at accelerating pace. But if so, at some point, the market is probably going to catch up to those earnings, and that could be one catalyst that pushes it to the upside. But of course, there's some factors that could push them to the downside as well, the earnings estimates as well as the market as a whole. And one that we'll focus on today is the interest rates. This goes back, back to the lows of the pandemic here for the 10-year yield. Had a really strong move off of that. But here for the last almost year, it's been trading really sideways. Interest rates have. And you can argue that perhaps we've just now broken out to the upside on interest rates. I think it's maybe a little bit early to definitively say that, but they're kind of leaning that way. And so, this is great for some people, those that, hated all the low interest rates that they were getting for their savings, retirees, for example. Now you get a higher amount. But for those that are, wanting a mortgage or a car loan or corporations issuing debt, this is more challenging. It's also more challenging for the stock market because higher yields offer more competition for stocks in some people's minds. So I think if rates kind of settle out around in this area or move higher at a slow pace, the stock market can do okay with that. But if they were to move up rapidly into high levels, I think that's where we would be concerned that perhaps stocks could revisit some of the lower ends of those trading ranges that we were looking at earlier. Well, as you talk about interest rates, a couple of things that are closely tied with rates are inflation and, of course, the Fed. The Fed has decided this month in September to keep rates steady where they are, their Fed rate. They may look possibly to raise one more time this year, depending on the data that comes in. And they claim that they're going to, not cut rates until late next year. That's just a far off prediction for them. It's hard to say. But obviously, they're going to be watching the inflation data closely. One of the tools for that is the consumer price index. This is a 20-year chart here, and you can see here in the last month, we actually ticked up just a little bit, around 3.5%. Normally rates kind of are mostly in this 2 to 3% range zone. The Fed would love to see things get back down there in a more stable manner. There's some different things working in both directions for us. Some of the commodity space, particularly energy, has seen a surge higher here in recent weeks. That's kind of working as a bit of a headwind. But other areas have come down a little bit. I know a lot of people last year couldn't believe the price of eggs, for example. They've come down quite a bit, and some other items like that. But I think one area that we have hope for continuing to bring inflation down, whether it's in the next few months or not till next year, is shelter. Shelter is a huge component in the CPI. And we know that a lot of people are putting their homes on the market for sale, but home builders keep building, at a fairly modest pace. But what they are building is multifamily units, apartments. It looks like this is going to be a record year for apartments being built. We've seen other data that shows some cities, including here in the Southeast, high growing area, believe it or not, there's some areas that are going to be have too many apartments potentially. So you're likely to see rents continue to stabilize and perhaps even decline on an absolute basis in some areas. So that will be a relief to the Fed. That could potentially help with inflation, with the interest rates and all of that. But there's a lot of moving parts. So I don't think that's going to happen in a straight line, or we could even go higher a little bit in inflation before then. So, a couple of things that I wanted to say in closing here. If we are in fact continuing to be in this sideways range for stocks, I think that's really an ideal time for dollar cost averaging. I mean, if you're still working and contributing to, your 401k or to, your accounts that we manage, we think a monthly contribution or a quarterly contribution is great. That way you're not being sure you're not going to buy it all at the high, or, if the market does go down, you'll be buying some then. So I think dollar cost averaging is a great way to go about things. If you're a retiree, you might be saying, hey, I'm taking money out right now. I'm not putting money back in. I understand that. But look at it this way, with those high rates for, cash and short-term bonds, maybe use your Social Security, and if you have a pension, to cover some of your expenses. And what is not covered, maybe keep anywhere from 6 months to 2 years of that in these short-term rates that are really good right now. We can help you create something for that. And then the rest of your money can be invested, and you don't have to worry about the volatility as much, because you've got your shorter term expenses covered for a while. So we'd love to talk to you more about any of that, or help you with any other questions that you have. You know where to reach us, and we hope to talk to you soon. See ya. Take care. Bye.